I have a client that works at Reddit, and over the last 6 months, the stock has been going bonkers, up 140% in 6 months. Now, they have a lot of RSUs or restricted stock units. Let's talk about the taxation here. In May, they were granted 1,320 shares at $118 per share. Now, if you look at the Reddit stock, this was pretty damn good timing because it would have been granted at 220 had they been there a couple months earlier. But in May, it was around this $118 price. Now, what happened since May? Rocket ship. So what happens in August? 25%, like we just said, shares are vested. So that's 330 shares. That's simply 25% of the total amount of shares granted or promised. Now, in August, these happen to be trading at about $218 per share. So that is what you're going to receive. 330 shares at 218 bucks. What is that in total dollars? 71,940, roughly. Now, this is where the confusion starts. This amount is going to be taxed as if it was paid to you like a bonus or just a normal W-2 salary. Now, you might be able to change how much the withholdings are, but as far as Uncle Sam is concerned, this is just a regular paycheck. So whether you want to hold the stock or just sell it and move it to a different platform, you're going to pay your federal, 28% potentially, or at least you can choose the withholding amount in some cases. State, California usually requires you to withhold about 10%. Again, Florida, it might be 0. Texas, 0. Michigan, it's 4.25. Then you have Social Security tax. You have Medicare tax. You have the additional Medicare tax on income earners over 250 married filing jointly. You have California, this is just for California disability tax. So the total tax withholding is about 48%. So you're left with then after the withholding, $37,500. Now this is again where the big kicker happens. What do you do now that you have $37,000 in Reddit stock? The most obvious one is you could just simply sell the stock and transfer the money to your bank account. And if you do that, there is going to be no additional tax owed. It's just like you received a paycheck. You paid tax on it and it went to your bank account. We're done. But if you did nothing, sometimes the answer is it stays in the stock. You're still now holding it or you kept the stock. This would be the equivalent to moving money from your bank account and buying the stock because a new date starts here. So now what happens? Let's say that you hold the stock for a month and it goes up 10% and then you want to sell it. You've now just created a capital gain. You bought it for $37,500. It's now worth $41,000. And if you sell it, you have $3,700 of capital gains, short-term capital gains. And short-term capital gains are taxed as ordinary income. Now, the only difference is that there's no FICA. So let's go ahead and grab now these taxes are only on income that is actually earned, wages. But short-term capital gains, you're going to have to pay federal, you're going to have to pay state. So you're going to end up paying, in this example, 38% or $1,400. So you get to walk away with how much you have minus the tax. You're walking away with $39,000. Now the last scenario, assuming again that you kept the stock or held it, would be if you held it for over a year. So instead of selling it on September, a month later, you held it all the way to August, over a month or over 12 months later. Again, very similar example. Let's say it went up 10%, so it went all the way up to $41,000 in total value. Well, you paid $37,000 or you continued to hold at $37,000. So now you have a gain of the same exact amount, that $37,000 or $37,599. Biggest difference here is that this is a long-term capital gain. Now the bonus here of long-term capital gains is that they're lower. Short-term capital gains, you're paying it as if it's normal income. That sucks. Long-term capital gains, it depends on your tax bracket and your income. So for example, if you're married and you earn less than $96,000 a year, you actually don't pay anything in capital gains rates. It's a 0% capital gains tax rate. But if you're married and your income is between basically 100 and 600, you're going to pay 15%. 15%, that's kind of the most common here. Which obviously you can see 15 is less than 38, and then you're going to pay quite a bit less in tax and take home more. Now going all the way back to our original example, you get promised some shares, they vest, you pay tax just like it was paid to you in the form of a bonus or a W-2 salary. What I will often recommend people to do is just sell your shares. Because what I would encourage you to think about is the reverse. What if this money wasn't given to you in the form of stock? What if this was given to you in the form of cash and it's sitting in your bank? Would you actually take $37,589 and go buy your company stock? Probably not. Like, you would have to be just so overly bullish on the stock that not only do you want to receive your income from this company, but you want to put your life savings into it. That's very concentrated. That's very risky. Now, maybe you want to do that with a portion of your money, but what I will often tell people to do is just go ahead and sell, and then maybe we got to take a deep breath and talk about what the goal is here, and maybe we want to hang on to a little bit or maybe reinvest a little bit. But if you have future shares coming down the pipeline, you have already a lot of future invested stock in this company. Maybe it's okay to take a little off the table. Thanks for coming to the video here. Hopefully you learned, and obviously everything I said here is educational purposes, not advice. Thank you.